You spent 30 years building toward one number, $3 million. You hit it, maybe even passed it. And then a financial advisor sat across from you and said you're still at risk of running out of money. Here's the part that should bother you. If that advisor tells you to move a third of it, $1 million into low-growth CDs and annuities, that single move can cost you more than $2,400,000 in growth over a 20-year retirement. That's not caution. That's what I call the wealth anxiety trap, and it's built right into how a lot of retirement advice gets sold. A lot of that fear traces back to 2022, the one year in decades when stocks and bonds fell at the same time. Advisors still lean on that single year as the reason to keep a third of your money parked in something that barely moves. One unusual year became the excuse for a permanent decision, and nobody ever goes back to check whether the excuse still holds up. I've watched this happen to people who did everything right, people who saved more than almost anyone around them, and still walked out of that meeting more scared than the day they started. This isn't about how disciplined you were or how well you invested. It's what happens to almost anyone once their number gets big enough to feel like it could disappear. Most advisors aren't plotting against you. Many of them are managing their own fear of losing a client during a downturn, more than they're managing your actual risk of running out. That difference matters, and it explains almost everything that happens next. So here's where we're headed today. The hidden math behind why a $3 million retiree often feels more stressed than someone sitting on $500,000, and the one number, your enough number, that can shut that fear down for good. Let's look at what actually happens when an advisor tells a $3 million client to get safe. The usual move is called the one-third rule. You take a third of the portfolio, in this case $1 million, and park it in CDs, or a deferred fixed annuity. Here's the number that rarely gets mentioned out loud. If inflation runs at 3% a year, and that annuity has no cost of living adjustment, which most fixed annuities don't, you can lose roughly $118,000 in real purchasing power over just 10 years. The money is still sitting there on your statement. It just buys less every single year that goes by. This usually isn't about hurting you. Advisors call it a safety floor, and they often frame it as protecting your identity as a successful retiree. What's really happening underneath is that many of them are managing their own risk. If the market drops right after you retire, and you're pulling money out while it's down, that's a sequence of returns problem, and it can cost an advisor a client. Moving you into something fixed makes their year easier, whether or not it makes yours better. Run the actual numbers over 10 years. $1 million in a fixed annuity paying 4.5% grows to $1,552,969. That same $1 million in a portfolio split between stocks and bonds, roughly 60% stocks and 40% bonds, averaging a historical 7%, grows to $1,967,151. The gap, $414,182, is the safety fee you paid. That's the invisible cost of choosing comfort over growth for money you may never have needed to protect this hard in the first place. Meanwhile, Social Security got a 2.8% cost of living adjustment for 2026. That benefit check keeps pace with prices every year. Your fixed annuity principal does not move at all, so the safe money is quietly falling behind the exact kind of income the government already adjusts automatically, which raises the real question. If a $500,000 retiree sleeps just fine without any of this Why does a $3 million retiree feel like the walls are closing in? That's not a math problem. It's a wiring problem, and it's exactly what we're unpacking next. A retiree with $500,000 usually knows exactly what they can afford. They lean on Social Security, they draw a modest amount each month, and there's a kind of clarity that comes from having limited options. A retiree with $3 million doesn't get that same clarity. Instead, they get what I'd call proportional anxiety. There's a name for the $500,000 retiree's advantage. Call it constraint clarity. When you don't have much room to maneuver, every decision gets simpler almost by default. A $3 million portfolio removes that constraint, and without meaning to, it removes the clarity that came along with it. Watch what happens in an ordinary 20% market drop. The $500,000 retiree loses $100,000 real money, but a number they can hold in their head without much trouble. The $3 million retiree loses $600,000. That's the price of a house, gone in a single bad quarter, at least on paper. The fear isn't irrational. It's just aimed at the wrong target. The dollar loss feels bigger because it genuinely is bigger. But the actual damage to your retirement, whether you can still pay your bills and keep your lifestyle, usually barely moves. The invisible cost isn't the drop itself. It's what happens when that fear pushes you to lock up money you were never actually going to spend. Money that could have kept compounding for another 20 years. So here's a simple way to separate the two. First, add up your floor expenses, the non-negotiable costs, housing, healthcare, food. Say that comes to $80,000 a year. Second, subtract what Social Security already covers, say $50,000. That leaves a gap of $30,000 a year that your savings actually need to produce. Third, multiply that gap by 25. $30,000 times 25 is $750,000. That's roughly your enough number, the amount that needs to stay untouchable. Everything above it is growth money, not survival money. I used to think more was always better. I spent years working with people who were closing in on $5 million. And I kept noticing they were more miserable than clients sitting at $1 million because they felt like they had so much more to lose. Eventually, I stopped coaching people toward a bigger number and started coaching them toward their gap instead. If you're in that 55 to 65 window, and you're tired of feeling like a target every time you sit down with someone selling a product, subscribe to WES Investor. We build around your enough number, not somebody else's quota. So if your enough number turns out to be $750,000, or even $1,500,000, and you're sitting on $3 million, ask yourself why you're letting anyone treat you like you're on the edge of running out. That question matters even more once you look at what's actually happening to your taxes in 2026. There's a change for 2026 that most advisors mention in passing and then quietly ignore in their actual advice. Under the One Big Beautiful Bill Act, anyone 65 or older gets an extra $6,000 tax deduction. Married and both 65 or older, that's $12,000 off your taxable income. There's a catch built into it. That deduction phases out once your income crosses $75,000 for a single filer, or $150,000 for a married couple filing jointly based on modified adjusted gross income. And this is exactly where the one-third rule comes back to bite you. When an advisor pushes a chunk of your $3 million into high-yield CDs or annuities, that interest is usually taxable, and it shows up on your return every year, whether you spend it or not. Push your income over that threshold, And you don't just lose part of that $6,000 deduction. You can also trigger something called an IRMAA surcharge on your Medicare premium. Picture $1 million sitting in CDs paying 5%. That's $50,000 of taxable interest showing up every year, whether you touch it or not. Layer that on top of Social Security and a modest pension, and crossing that $75,000 or $150,000 threshold happens faster than most retirees expect. Here's what that actually costs. The standard Medicare Part B premium for 2026 is $202.90 a month. Cross into the higher income brackets, and that same premium, for the exact same coverage, can climb to $689.90 a month. That's the quiet cost of income you didn't need to generate in the first place. Ask yourself this. Did your advisor mention the phase-out number when they recommended those CDs? If not, that's a conversation worth having before the next tax year closes out. Back in 2022, investors ran towards safe assets and got hit by inflation instead. The lesson most people took from that was the wrong one. It was never really about the market. Today, the real risk sitting inside that $3 million portfolio isn't a crash. It's bracket creep. Dollars quietly nudging you across lines you didn't even know existed. It's not what you make that decides your outcome here. It's what you keep after taxes and premiums take their cut. And there's one more thing a lot of advisors still get wrong about your Social Security, something that changed at the start of 2025, that a lot of them haven't caught up with. Say you spent years as a teacher or a police officer, and you've also got a private sector pension sitting alongside your Social Security. For decades, advisors told people in that exact position that their Social Security would be cut through something called the windfall elimination provision. That's no longer true. On January 5, 2025, the Social Security Fairness Act repealed both the windfall elimination provision and the government pension offset. If your advisor is still working off older software or knowledge from before that date, they may be underestimating your guaranteed income by $500 to $1,000 a month. If you've spent years budgeting around a benefit you were told would be cut, it's worth sitting with how much of that worry was based on a rule that no longer exists. That's not a small thing to carry for no reason. That's not a small oversight. For some retirees, that's tens of thousands of dollars of guaranteed income sitting on the table, income that doesn't depend on the market at all and never runs out as long as you're alive. Picture two versions of the same retiree. The unprepared one buys a $200,000 annuity to patch a Social Security penalty that no longer applies to them. The prepared one checks the current rules first, realizes their income floor is already fully covered, and leaves that same $200,000 invested in the market instead, where it has decades left to keep growing. It's worth asking your advisor directly whether they've pulled a current benefit estimate since January 2025. It takes one phone call to find out, and the answer could change how much of your own money you actually need to keep locked away. Now that we've found income you already have, the next question is how you protect the rest of that $3 million from a real crash, the 2008 kind, without buying a product that quietly punishes you for the rest of your life. Here's the actual structure that neutralizes the fear, instead of just talking you out of it. It's built in 3 buckets, and it only works if you set it up before you actually need it. Bucket 1 is cash. Keep 2 years' worth of your gap. Remember, that's floor expenses minus Social Security, sitting in Treasury bills or a high-yield savings account. This is the money you spend, no matter what the market happens to be doing that year. Bucket 2 covers years 3 through 7. This is where a TIPS ladder, or a set of short-term bonds, does its job, laddered so something matures every year. This bucket exists specifically to protect against the sequence of returns, risk your advisor keeps warning you about, without needing a commission product to do it. Using the $30,000 gap number from earlier, Bucket 1 holds around $60,000 in cash to cover those first 2 years. Bucket 2 holds roughly 5 more years of that same gap, close to $150,000, spread across TIPS and short-term bonds. That's less than 10% of a $3 million portfolio, doing all the work of keeping you calm. Bucket 3 is everything else, the remaining $2 million or more, and it stays in a diversified stock portfolio for the long run. This is the money that's allowed to be volatile, because you're not touching it for at least 8 years. The bigger your portfolio, the smaller a percentage the first 2 buckets actually need to be, and that's the part advisors rarely explain when they're recommending. You move a full third into something fixed. Here's why that matters. If the market drops 30% in your first year of retirement, you don't sell a single share. You live off Bucket 1. Historically, the S&P 500 has taken around 2 years to recover from major drops, roughly the same pattern seen after 2008 and after 2020. And by the time you'd actually need to touch Bucket 3, the recovery has usually already happened. I keep my own version of Bucket 1 in a plain brokerage account. I don't pay 1.25% a year for a guaranteed income rider just to watch my own money move around in circles. The buckets do the same job for free, and I know exactly where every dollar sits and why it's there. None of this requires predicting the next crash or timing when to get back in. The buckets do that work automatically, just by existing in the right order. But buckets only work if you can actually leave Bucket 3 alone. So what happens when the math says you're fine and you still can't stop checking the balance every morning? That's not a spreadsheet problem. That's next. There's a name for what you're feeling, and it's not a character flaw. It's called loss aversion. For most of human history, losing a meal mattered more than finding an extra one, because a missed meal could kill you and an extra one was just a bonus. Your brain still runs on that same wiring today. So losing $1 million feels like a catastrophe, even when you still have $2 million left and only actually need $1,500,000 to live the way you want. That reaction is normal. You spent 40 years as an accumulator, someone whose whole identity was built around the number going up. Retirement asks you to become a decumulator almost overnight, and that switch is genuinely disorienting. It isn't weakness, it's a real identity shift, and it deserves to be named as one before anyone hands you a fix. That's the emotional cost nobody puts in a financial plan, and it's just as real as any number on a spreadsheet. Here's the shift that actually helps. Stop watching your net worth and start watching your withdrawal rate instead. If you're pulling out less than 3.5% of your portfolio a year, you are mathematically safe, whether the account says $3 million or $2,500,000 after a rough year. The number that scares you on your statement isn't the number that determines your future. We've covered the math, the tax traps, and now the wiring in your brain that makes all of this feel heavier than it needs to. None of it required a single prediction about where the market goes next. Put those 3 pieces together, and you'll know exactly what to say the next time someone hands you the 1/3 rule. Let's land this. $3 million is a position of real power, not a warning sign. Don't let the 1/3 rule, or an outdated fear about a Social Security penalty that was repealed back in January 2025 push you into products built to calm someone else's nerves instead of yours. Wall off your enough number using the bucket strategy, keep it untouchable, and let the rest of your money do what money is supposed to do over a long retirement, which is grow. That one shift, walling off enough instead of chasing more safety, is the difference between managing a portfolio and managing your own peace of mind. You built this by making steady decisions for 3 decades, not by chasing headlines or timing markets. That same steadiness is what carries you through the next 30 years if you let the plan do its job instead of your fear. If you want a retirement plan that treats your peace of mind as seriously as your principal, subscribe and join the rest of our 55 to 65-year-old community here on WES Investor. You didn't save $3 million to spend your retirement worried. You saved it to be free. Go live like it.